Good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in the market. Today, we're going to start off with Will Hares, who just published a React here recently on Shell's decision to change its share offering and relocate its headquarters to the UK. So, Will, tell us about your note and what you think's in store for Shell going forward.
Yeah, thanks, Rob. So I think the key takeaway from Shell's announcement is for investors to understand that its current share structure is very inefficient, considering the company's near-term return strategy, which relies heavily on buybacks. And just quickly to maybe explain it as simply as possible, Shell has an A-B share structure. Its A line of shares is subject to a 15% Dutch withholding tax. Its B line of shares is not, is based in the UK. And so when the company is buying back shares, it makes buying back A shares incredibly inefficient. So its B shares is the primary target for buybacks. But what this has done is this limits the pool of shares for the company to buy back from. And so the proposal for the company to move to a single line of shares will primarily simplify their corporate structure, provide optimized value visibility for investors. It's more comparable to peers. But the main takeaway is that it's positive for the company's buyback program. It provides a much larger pool of shares for the company to buy back from. And along with that, you have much improved trading liquidity for the company to execute these buybacks. And why this is important is because buybacks form a central component of the company's return strategy moving into next year. They recently resumed their ongoing buyback program at about 1 billion per quarter. We expect this to extend at least next year. And then we also have a further 7 billion of proceeds that management has promised to distribute via buybacks from their Permian shale portfolio sale to ConocoPhillips, which is expected to close by year end.
Thank you, Will. Very interesting development. I'm sure the Brexit crowd is celebrating this announcement. While I've got you here, we just wrapped up the COP26 climate conference just today in the FT. Someone from the World Coal Association had a note out saying, coal was here to stay and it's time to stop bashing the fuel. I think that probably runs a bit counter to how we're expecting coal to unfold, particularly here in Europe over the next decade or so. But what's your sense, what's your readout from the conference, and are there any implications for a company like Shell or any of the other integrated energy majors these days?
So on oil majors for COP26, I think the outcome from the conference is broadly as expected. I would argue that most of the European oil majors' transition strategies are already relatively complementary with COP. I mean, most of these companies are targeting net zero by 2050. Investors are pushing them to disclose more on emissions and on ESG more broadly, pushing them to strengthen their targets on absolute emissions rather than intensity, pulling forward certain benchmarks and milestones for near-term progress. And so I think that many of these companies, they already understand very clearly what both investors and the wider public want, and they are some of the more progressive, shall we say, within their peer group, particularly when you compare them to the U.S. majors, Chevron and Exxon, which have done almost none of these initiatives as far as emissions compared to the Europeans.
Very interesting, Will. Patricio, Alveraz, who covers our utilities, I want to get your take on this as well. What's your readout from COP26? You spend a lot of your time here recently listening to 3Q earnings for the European utilities. Are they envisioning a comeback for coal as some in the coal industry would certainly hope for, despite the rhetoric out of COP?
So the short answer there is no. I think the overarching message from all the utilities in Europe is to double down on renewable capacity expansion over the next decade. Most of the companies I cover are already on track to the 1.5 degrees Celsius target. So if anything, the COP26 became a catalyst to shun the phase out of coal even further. And this presents a particularly important challenge for utilities in Germany, where the coal phase out is likely to be accelerated from 2038 to 2030. And we've seen in recent investor days sort of a greener tilt, just more ambitions on those capacity deployments for offshore wind, onshore wind, and solar, and now expanding, diversifying beyond Europe, and sort of a declining reliance on coal. Even though the set target is 2038, most companies will have very little reliance on coal earnings by 2023.
Very interesting, Patricio. An interesting data nugget is that our expectation is that the solar industry is going to grow about 30% this year. So that's the annual capacity additions. Next year, we think it could grow 15 to 30% again. So there are plenty of other fuels hoping to eat coal's lunch. With that in mind, I want to bring on our colleague, Salih Yilmaz. Salih is actually not with us in the office today because he's at the ADIPEC meeting in Abu Dhabi. So Salih, I think great place to start would be with COP26. How much are you hearing at the conference? Are folks actually talking about the issue of emissions, or is it full steam ahead on upstream activity and much more of a focus there at the moment?
Hey, Rob. Actually, they have, and it's very interesting because, I mean, ADIPEC is one of the largest oil and gas conferences in the world, and I think it's always been very interesting because it always attracts some of the CEOs from the largest oil companies and almost all relevant ministers. But this year especially, because it immediately followed the COP26 meeting, I think we knew that this was going to be even more interesting than usual. And I mean, we just closed the third day and tomorrow is the last and fourth day. It actually delivered in the sense that there has been a lot of talk about COP26. We've been told that there's been a lot more talk about energy transition. There's been a lot more talk about hydrogen, which has been something that everyone would have dismissed, I think, even if it was mentioned in the past ADIPEC conferences. So clearly, there was a lot of influence that COP26 meeting in the past few weeks had on it. And my observation, especially from the first day, was that all the speakers kind of almost in an agreed upon way were re-emphasizing the importance of energy security. So everyone has been talking about energy transition, but they kept saying, but at the same time, we need to make sure that we have energy security, especially for the developing parts of the world. So I think another theme that's been repeated by most of the speakers have been underinvestment in upstream. This is something that we've been writing about for a while now, and I think this also echoes IEA Outlook report that we saw on how, I mean, for the energy transition, we need more investment in renewables and other low-carbon energies. At the same time, currently the upstream spending, just to keep the same level of supply, not even more, we would need to, the oil companies would need to increase spending in the legacy fossil fuel businesses as well. So I think kind of the re-emphasis of energy security is definitely something that kept coming back in almost every speech. And I think underinvestment is something that everyone is talking about, and many people seem to be concerned about, because I think if we do see kind of demand roaring back to pre-pandemic level or above, and we see OPEC spare capacity, which really is what's giving this cushion to oil prices, which are already up at above $80 a barrel. If we see that shrinking next year, and we already have relatively low inventories, I think a lot of people are concerned now that we might be in a crunch environment next year for the oil market.
Salih, I like your framing of energy security. That makes a lot of sense. And one of the conversations that we've seen a lot of discussion about is the U.S. position in the supply mix. And I think some folks think that the President Joe Biden and his administration have a tilt to be less favorable towards the oil and gas industry versus some of the prior administrations in the U.S. But what's your sense? Are folks in ADIPEC thinking about where the U.S. could be headed in terms of its oil production? Is the U.S. still going to be sort of the swing supplier in the mix? Curious to hear your thoughts.
Yeah, I mean, I think, first of all, I think President Biden is in a little bit of a tight spot at the moment, because there really isn't too much that he could do about this. There isn't really a switch that he could turn on or off to make this go away. But what we've been hearing, and we actually had the IEA monthly report yesterday as well, is that there is this increasing kind of expectation that the non-OPEC supply will actually ramp up a little bit, and more than 90% for the growth that's expected for next year is expected to be from U.S. shale. Again, I mean, these are estimates that get revised every month pretty much, so like this is a big uncertainty, and I think this really will become one of the most important, alongside how well demand does. This will be one of the most important factors for the oil market and for the oil prices next year, how much U.S. shale can really respond. But when you look at kind of the cost of production and the break-even cost at some of the new fields in the U.S., I mean, these are in the $40 a barrel region, according to our colleagues at Bloomberg NEF. And I mean, of course, we know that the kind of economic feasibility is not the only parameter anymore. Obviously, these companies, investors at these companies are asking for returns, shareholder returns now, rather than growth. And we do see, I mean, in the financial market, whenever we hear an oil company even mention oil output growth, they get punished. Their share prices get punished. But again, I mean, the longer oil prices stay relatively high, obviously we will get a shale response, and it's going to be it is going to be one of the most important things, I think, next year on how much it can respond.
Will, I want to get your sense on this as well. When you think about the European oil majors, obviously they've got operations all over the world. Where are they deploying CapEx right now? Are they active in the U.S. shale market? Are they doing longer cycle projects in other parts of the world? And what's your sense on kind of how they're thinking about the supply-demand balance over the next 12 months?
Yeah, so for the European majors, we've seen a pretty clear trend over the last several years of de-emphasizing U.S. exposure, particularly in the shale patch and growth. And so we've seen investment follow that. And there's been some notable high-profile divestments as well. BP just had a large one. We've seen Equinor sell down most of its shale exposure in the Eagle Ford and the Bakken. So overall, we've seen and of course Shell's divestment to ConocoPhillips So overall, it's been pretty clear that the shale patch, the U.S. shale patch, is not an area of focus for the European majors, and instead we're seeing a much bigger focus in LNG and in build out of LNG portfolios. Deep water oil is still a major engine for many of these companies. That's in the Gulf of Mexico, in offshore Brazil and West Africa are the key provinces there. But then also we've seen increasing interest and deal making in transition businesses. So build out of renewable power capacity, both in offshore wind and in solar. So I think this really shows that that this high capital intensity, high decline rate oil production that we typically see from the U.S. shale patch is not that complementary with the prevailing strategies of most of the European majors.
Fascinating to imagine that the U.S. shale patch has fallen out of favor with the European folks. I understand your narrative there, but let's bring on Patricio to comment. Will mentioned LNG as one of the areas of focus for the European oil majors. Obviously, we're in the midst of a still very elevated natural gas price. What's your expectation for where the gas price is at, where it could go, and how did the utilities talk about the surge in their 3Q earnings calls?
Sure. So I think I'll address the first question by just highlighting that storage levels in Europe remain below their 5-year norm by about 16%. So we're about 74% full, and the withdrawal season has started when demand actually picks up due to colder weather. This combines with a forecast of a cold spell entering Europe over the next 2 weeks. And this comes on the backdrop of ebbing flows from Russia, which is Europe's major gas provider, providing about more than a third of the gas in Europe. And as we were speaking today, news just in that the Nord Stream 2 commissioning may be delayed to March. So originally the pipeline was completed in September, and the original agreement was that it could be approved in 4 months. So that means that there's a potential delay of at least 2 months on the cards. And while these doesn't surprise us too much, we assumed that this was a possibility that Europe would have to face a winter without Nord Stream 2, and that supplies would just continue the way they are. We do see prices sort of remaining at these very elevated levels. Perhaps not at the records that we saw in September, which seemed to, be a combination of other factors like LNG demand in Asia and other sort of global trends. So we don't see it coming back, but we see a visibly tight market for gas over winter at least. So that's on the price front. And when we talk about how utilities have reacted or responded to the volatility in gas, we've seen we haven't seen a lot of a big impact on the finances of the large European integrated utilities, but rather temporarily increased working capital needs that should be resolved over the next few months as their hedge positions close out. In terms of how this affects their outlooks moving forward, gas is gaining traction as a transition fuel, as the easiest path out of coal for sure, and has been mentioned quite a bit more substantially in investment plans as they try to just to sort of compound it within a flexible generation unit that a lot of utilities are calling it, which combine a combination of pump storage, hydro, and a big share of gas, which is kind of stuck there. So this dovetails with a lot of the utilities' push to have natural gas included under EU green taxonomy, which would be a major boost, I think, for several operators here in Europe.
Very interesting, Patricio. Okay, Salih, I want to come back to you for another comment reacting from Patricio and Will. When you're there on the ground in UAE, I'm curious to what the sense is on the energy transition, and particularly I'm curious about the expectation around medium to long-term oil demand. I mean, we've all know demand has come roaring back over the last 18 months, but where is it going to be in 5 years, 10 years? Are they worried about the rise of EVs? I mean, I'd note, I think EV sales were very close to 20% in October in China of their total new car sales. So we're seeing some pretty staggering numbers out there. Are folks in broadly the oil patch worried about it yet?
I think so, and I think increasingly. I think looking at, in this region, I think looking at Saudi Aramco, which is the Saudi Arabia National Oil Company, and ADNOC, which is the Abu Dhabi National Oil Company, are a good proxy of what the region thinks about the energy transition. And I think it's a little bit complicated because we know and we heard at ADIPEC yesterday that ADNOC is signing a record $6 billion contracts for oil and gas drilling, and this is obviously being driven by its aim to boost its capacity of oil production by almost 1 million barrels per day. So obviously in the short to mid-term, they do believe that oil demand will be strong, and because they are one of the lower cost producers, even beyond mid-term, they think they will continue to be one of the producers that can supply oil at a relatively low cost. And I think this is very similar for Saudi Aramco, because we know they are also planning to increase their oil production capacity by about 1 million barrels per day, from 12 million barrels per day to 13. So in that sense, they are still very much invested and will continue to invest into their legacy oil and gas business. But at the same time, I mean, again, we did have officials from these companies present, and they are indeed talking about energy transition more as well. And especially when we look at the UAE, because this is, I mean, the UAE did pledge to a 2050 net zero emissions for Scope 1 and 2. And for that, they do believe that hydrogen will play a big role for them. And they're talking about blue hydrogen now, but they think there will be potential for green hydrogen in the future as well. But they also announced at ADIPEC that they will spend up to $20 billion into their into gas projects, mainly the Dalma gas project, where Eni, OMV, and Wintershall are all partners as well. I mean, this is a huge gas project, and obviously some of it will go to be domestically utilized in power generation. They do have one LNG terminal, but they want to potentially build another one so they can export LNG. But they do now talk a lot about kind of using that for hydrogen and for blue ammonia, because they think, I mean, they don't think they'll be producing no oil and gas anytime soon, but they really want to be a huge exporter and a hub of blue ammonia as well. So I think it's a little bit complicated in the sense that their actions right now really show that they are still very much focused on oil and gas, increasing capacity, kind of increasing their market share, which I think will be available for them, as Will mentioned, oil majors kind of de-emphasize oil output growth. But at the same time, I mean, 5 years ago, would they have been talking about hydrogen? Probably not. I didn't hear them talk about it. But now they are, and I think these investments into gas projects are partly driven by kind of reasons that are kind of fossil fuel free exports that they want to be a big player for in towards 2050.
Okay, I want to give an opportunity for both Will and Patricio to react to the idea of hydrogen, but let's keep it short. We're running towards the end of our time here. So Will, we'll throw it to you first. Salih's hearing a lot about hydrogen at the ADIPEC meeting. What's your sense? You know, is this a real thing? I know some of the companies you cover are talking about it, but give us your read. Is this a real opportunity or just one of these things that will always be floating around out there?
Yeah, just really quickly, I think it is a real opportunity. I think it's going to grow enormously, but most of that growth is going to come beyond 2030, 2035. And just quickly, I think I'm quite suspect of the push for gray and blue hydrogen. I think green hydrogen is the ultimate goal. And those promoting gray and blue hydrogen are attempting to sort of talk their books, pushing for, you know, avenues which are the least disruptive to their existing business models.
Okay, Patricio, over to you. Give us your read. Hydrogen, is it 15 years out, sometime sooner, or not at all?
I would like to echo what Will said. It's green hydrogen. That's the only story amongst European utilities, and they see everything at the moment is in early stage for most companies, and we've seen increasing targets towards the end of the decade. So one outlier I'd say is RWE, which aims to have at least 2 gigawatts of electrolyzers by the end of 2030. I think that's the utility with the clearest target, but I can't deny that it's been repeated across all European utilities, especially those with a lesser emphasis on renewable generation and on electric renewable generation, wind and solar.
Very interesting. For everyone listening, if you want to check out the kinds of companies that are exposed to the hydrogen theme, you can visit BIBSKT, BI Basket. These are our theme baskets. We've got one focused on hydrogen. We've got another one focused on 5G. We've got another one focused on electric vehicles. And it's the intention of these baskets is to give you a sense of what kind of companies are active in the space, who's exposed to the theme. So check that out and shoot us a question if anything comes to mind after you take a look at it. And a quick advert. We are currently running a survey that we'd love for you to participate in. Salih Yilmaz runs it, so ping either me or Salih if you don't have the survey link and you'd like to participate. It asks questions about the future of oil demand and what's going to happen at the next OPEC meeting, things like that. We'll be releasing the results sometime ahead of the December 2nd OPEC meeting, and so again, we'd love to have you participate, and even if you don't, look for the results of the survey sometime in the very near future.